Hello and welcome everybody. We welcome you to yet another interesting and exciting session of Tinkerpreneur. Today we will be learning how to manage business finances with a very special guest, Mr. Prashant Nair. He is a Vice Chairman and Associate Professor of Computer Science and Engineering at Amrita University, Coimbatore. He is also a regional mentor of change with ATL Innovation Mission, and I would now request him to take the session forward from here.
Thank you, Tanvi ji. I hope I'm audible.
Yes, sir, you are audible.
Thank you. At the outset, I want to thank ATL Innovation Mission for this opportunity to be able to talk to the entire student community of such an exciting event, the ATL Tinkerpreneur 2022. Without much ado, let me just share my slides and then we can start. I hope my slide is visible. Yeah, thank you.
Yes, sir.
Yeah, so I'm very happy to give this talk on business finance. Incidentally, in the last 3 years, I've been associated with the ATL Innovation Mission in a pro bono capacity, in a voluntary capacity, supporting the wonderful initiatives that ATL Innovation Mission is doing. And of course, Tinkerpreneur is one of the flagship events. Before I kind of get into the topic, I want to just give you a perspective on the role that ATL Innovation Mission is playing in the development of this country. Today, more than 10,000 ATL tinkering labs are present in the length and breadth of this country in almost every single district in India. A revolutionary concept that has actually changed the face of innovation in India. And we have also started seeing the results. Today, India is ranked 46th in the World Innovation Ranking. And this 46th position has been from the 81st position in 2016. And no prizes for guessing that it is ATL Innovation Mission that has played a stellar role in this acceleration of India's innovation ranking from 81 to 46 in the last 5 years. The tinkering labs are hubs of innovation and are transforming the country one student at a time. And today we are going to talk about the Tinkerpreneur. The Tinkerpreneur is again a revolutionary concept. The idea that a student studying in a school can become an entrepreneur. Now, some people, while we are mentoring the students come with an apprehension. Oh, do you mean to say that I should, drop out of college or school like Steve Jobs or Bill Gates? Well, that's not the answer. The Tinkerpreneur, the ATL Tinkerpreneur gives you the skills, gives you the competencies, gives you the ideas, gives you the orientation so that you can embrace entrepreneurship. Now, when you want to be an entrepreneur is your choice. I mean, you don't want to do it after school, fine. These skills will help you when you go to the next level. When you go to college, you enroll in college, you decide, okay, now I'm ready to jump into entrepreneurship. That's when you take the plunge. In some cases, I've been teaching, college students for the past 22 years in Amrita Vishwavidyapeetham, Coimbatore. Amrita Vishwavidyapeetham is India's #1 private university and ranked 5th in the country in terms of universities out of more than 1,000 universities by the government of India. And I see, students after college, many of them say, sir, I am not interested in, working for a company. I want to be an entrepreneur. I want to be a job giver. I want to have a startup. So this is the kind of buzzword. So you can, this Tinkerpreneur gives you the tackles, gives you the tools, gives you the skill set, gives you the orientation so that you can embrace entrepreneurship at any point of time in your life. Maybe you decide, okay, after college, I want to work in a company for 5 years. Then only I will jump into entrepreneurship. Fine. But still, these concepts, these ideas really help you. Now, I just want to quickly, go through this, the Tinkerpreneur cycle, the 9 weeks that you are attending, and we have already completed 6 weeks. We are jumping into the 7th week with this session today on business finance, how to manage your finances. Now, just to tell a quick, the story of the Tinkerpreneur, you spent week 1 acquiring digital skills. There's so many digital skills are available on the KidX and Atal Innovation Mission Tinkerpreneur website. You would have developed a QR code, you could have developed a machine learning application, you would have done a digital product. Whatever is the case, you acquired digital skills in the first week. The skills were probably very simple. You made some music on your own, you built a QR code, you generated a QR code, you generated a website or an app talking about the historical and cultural locations in your locality. It doesn't matter. You acquired some digital skills. The next week, you refined your digital skills. You polished your skills. You understood, okay, I've started using a QR code. Now, how do I make it better? How do I improve it? I have started developing a app. Now, how do I make the app very user friendly? You refine it. In the third week, you focused on building a product. Now you had so many skills. Okay. Now you try to combine the skills, take the skills, modify the skills, combine the skills, and make some product. Well, like I told you an example, an app, an app on the historical and cultural locations in your city and how to go to them, how to visit them, all details, what are about them. And maybe in the future, you add an augmented reality to your app so that, even you're sitting here, wherever you are, you can feel as though you have gone to that historical place. That is the building a digital product. In the fourth week, you refined your digital product. Again, improving it, polishing it, making it look nice and beautiful, making it look user friendly, and so on. In the fifth week, you focused on the business models, so as to speak. How do you set up a business? Is it a brick and mortar business? Brick and mortar means, do you want to have a shop? Do you want to have a physical location? Or do you want to have a totally virtual location? That's the cute today. I wanted to give an example. A Chinese company called Alibaba. Alibaba is the largest retailer in the entire world. Alibaba does more business than all the Walmarts across the world. You can imagine an online retailer like Alibaba doing more sales and businesses and retail than all the Walmarts. If you've been to a Walmart, anywhere in the US, like Los Angeles or San Francisco, New York, I mean, it's an ocean. You don't know you get into one end, you don't know where the other end is. It's that massive. But still, being a virtual company, today Alibaba has outsold all the Walmart's brick and mortar shops. So what is your business model? How are you going to sell? Who are your customers? How do you reach out to your customers? What are the channels that you will be using? That comes in the business models, which you saw in the week 5. In the last week, you looked at branding, marketing, digital marketing. How do you use websites? How do you use social media? Facebook or LinkedIn or Twitter, YouTube, how to market your product, how to brand your product, how to make a brochure, a flyer, an attractive thing which will get you the customers. That's what you did in the 6th week. And today we are going to start. I think yesterday there was a session, but we are going to start with how to keep track of the money. Okay, you started a business, you started an online business, you started a physical business. Now you're getting money, you're getting sales. Now, how do you keep track of that? In the subsequent weeks, you will be looking at how you build a company, you build a location, either virtual or physical. How do you network, build collaborators, partners, and how do you get investors? That is the last week, the 9th week. Pitch and get investors to, anyway, that is coming forward. So today we are now looking at week 7. Week 7 is learning the business finance. Now, simply speaking, business finance is the science of managing a company's money. How do you deploy the money? How do you use the money? Now, this money has to be used at a short term, at a medium term, and at a long term. I will explain. Short term is day-to-day activity. Okay, you're having a shop selling Apple iPhones. Okay, you've got the iPhone 13, the latest iPhone 13 Pro. You're sitting in some tier 2 city in India. How do you let people know that, you got the iPhone, right? You have the stock. You probably put an ad in the newspaper, in the local newspaper. People come to know, and then they flock to your shop to buy the Apple iPhone. So this is an example of a short-term thing. Okay, iPhone stock has come, you put an ad in the newspaper, obviously you need to pay cash for that. That is a short-term requirement. Today the electricity bill has come. You have to pay the electricity bill. Otherwise, next month your connection will be cut off. That's again cash. You need money, cash, right? You have to pay the sweepers in your company or factory. Again, you need to give cash. Today, you have to pay all the sweepers. You have given a contract, but every fifth day of the month, you have to pay the sweepers. That becomes again a short-term kind of thing. At the same time, you want to develop your business. You want to expand. You want more locations, more branches. For that also, you need money, right? And that is the long-term kind of requirements of money. Investments. You're already having you're having a shop in one location in, say, Mumbai. You're having a shop in Bandra. Now you want to open a shop in Goregaon. You want to start another shop in Vashi. You need money for that, right? Those kind of things, expansions, adding more branches, adding more products, adding more kind of expanding your operations, all that called for also money, and that is the long term or the investments. So money is needed for both. And business finances, how do you keep track of the money? How do you take care of the money that comes inside, the inflow, and the money that goes outside, the outflow? Let us see that. So we are going to see basic concepts of business accounting. When I say accounting, accounting is a day-to-day activity. How do I maintain the company's fund? The fund means the money that is available in the bank, the money that is available in the by cash in your hands. How do I use the money for short-term investments, short-term expenses? How do I deploy the money for my future expansion? How do I pay for the materials that I buy? How do I pay my bills, my electricity bill, my water bill, my internet bill? How do I price my products? What is the cost that I should give my product? How do I sell them? How do I get the money? All these come under the domain of business accounting. Long and short-term management of money. All that comes under the business accounting. But it is an activity that happens on a daily basis. On a daily basis, you need to do account. You need to keep track of your finances. How much money is coming in? How much money is going out? How are you using the money? How are you deploying the money? How you are getting the money? Both are important. And that is why we say accounting helps a business to track its income and expenditure. Income is money that is coming inside. Expenditure is money that is going outside. As also, business accounting helps you are required by the law of the land to keep track of all these things. As a company, you are a public entity, whether you are a startup, whether you are a college, whether you are a university, whether you are a hospital, whether you are a factory, whether you are a showroom, whether you are even a small, what should I say, mom and pop store, right? A small shop. You need to keep track of all these things. The law of the land, the law of the country requires you to keep adhere to all the government rules and regulations, and whatever be the type of your enterprise, you have to comply. And finally, accounting helps you to make sound business decisions. You are able to make intelligent business decisions based on this information. Let us see how. Now, quickly, what is the cycle of accounting? How do you take the cycle of accounting? Accounting means you are keeping a track of all your financial transactions. Now, transactions may be physical, transactions may be electronic. And we have seen also that during the pandemic period, we have seen a spurt, a sea increase in terms of electronic transactions. Either way, any transaction, it can be either physical or electronic. You may be giving a check, you may be giving cash, you may be doing an NEFT transfer, fund flow, you may be doing a UPI, you may be using Phone Pay or Google Pay or Paytm. Every single transaction has to be recorded. That is the essence of accounting. Now let us see the cycle. You have business transactions. You're selling, you're buying, you're paying your bills. You may be doing it physically by cash. You may be doing it by check. You may be doing an NEFT transfer. You may be doing a UPI transfer. Every single business transaction requires a document. Every single transaction. There is a document, means the document need not be a physical paper. It can also be in the electronic way, right? Every single transaction requires a document. The document can be a purchase order, an invoice, a receipt. These can all be online also. That's not enough. You need to enter every single business transaction of money coming inside, money going out inside what is known as a journal. A journal is like a diary. Today is the 13th June 2022. Paid electricity bill 10,000 rupees. Paid salary for sweepers, contractual staff 50,000 rupees. Got the revenues, the sales from one branch. Money has come inside. So every single transaction of money coming inside, money going on inside, there is a journal, a chronological, a historical document that records everything. Now, of course, many of these things you can do online. You don't have to make a book. In olden days, even today you will see in some of these small family businesses, they keep a big book and they start writing the transaction. Today all these can be done online. There is a software called Tally. Every information you can journalize. Every transaction, number one, requires a document, and then you need to enter into a journal. That entry can also be, mostly it is now electronic, using software like Tally. Next, any amount that is debit or credit. Debit means money that is getting minused from your account. Credit means money that is being added to your account. All these are posted to what is known as a ledger. A ledger, again, mostly today it is electronic. All these journal entries, right? Journal entries are all collated and then you post it to a ledger. Ledger again is like a summation. Okay, all the electricity bills, it will be in one location in the ledger. All the water bills, one location. If you are running a house, all the salaries for sweepers, it will be an entry. Like that, you combine everything, you collate everything, and you post it to a ledger. And from this ledger, you get what is known as various financial statements. You will get a cash flow statement, you will get an income statement, and a balance sheet. I will explain these three statements little later. So just to cut the long story short, any transaction that you are doing, money coming inside, money going outside, every single transaction has to be recorded. Number one. Number two, a document is needed for each and every transaction. It can be a purchase order, it can be a bill, it can be a receipt, it can be an invoice. It doesn't matter. That document is needed. This document can be electronic. That's fine. Third thing, all these are historically entered in a journal. Day by day, hour by hour, month by month, we maintain the details in a journal. Journal is like a historical record. Every day, this many things have happened. And this can also be completely electronically done, like software like Tally. And finally, this journal will amalgamate into what is known as a ledger. A ledger will have very clear files or sub areas where each expense can be grouped or each revenue can be grouped together. So if you go to Tally, just go to the computer and Tally, say, give me all salary for sweepers from January to December. You just click a button from the ledger. It will take all the entries where you have paid salary to the sweepers in the last 12 months. That will come out. Now let us take electricity bill. Electricity bill is a variable thing. You don't know this month how much electricity you use, you cannot predict. Next month how much you use, you cannot predict, right? So it goes on changing, right? And because of that, you can't predict that. So you want to know January how much I paid the electricity bill, February how much I paid electricity bill. You just go to the ledger, ask in the software and ask a question, then it will give you the details, right? So that is how these things are done. Now most of this has become completely electronic. There are softwares available like Tally. Then there are also ERP, something called ERP packages. Big companies have got what is known as ERP packages where all these things are available and very easy. You can sit anywhere in the world and do these things. You can use it from an app. All these things are today available. So this is the process of accounting. Now let us see the documents that are needed for accounting. Again, I told you these documents can be completely electronic, but for simplicity's sake, I am explaining physically. You have a purchase order. A purchase order comes from a customer to a seller or a vendor. I want to buy something. Suppose I have a shop where I'm selling mobile phones. Okay, I'm having a shop somewhere in downtown city and I am selling mobile phones. And I need to order Samsung Galaxy phones. I need to order iPhone, Apple iPhone Pro 13 Pro phones. So I talk to Apple. I am the customer. As a customer, I am asking Apple. I send a purchase order to Apple saying that I want mobile phones. I want 50 iPhone 13s. I want iPhone 13 Pro. I need 15. I will pay you a unit price of say 1,20,000. Outside it is 1,40,000, but I will pay you a special rate of 1,20,000. I want this delivery to this address. I will pay you the money through bank on this date. All these things will come in the purchase order. So the purchase order will give you these details. Remember, purchase order is from a customer to a seller or a vendor. Okay, I have a mobile phone shop. I raise a purchase order to Apple. I ask Apple for 50 iPhone 13 Pro. I say that I need 50. I need it delivered by this date. I will pay you 1,20,000 per iPhone 13, and I want this to be given by this date. I will pay you through check or NEFT, and this is my details. If you have any doubts, please call me. This is what a purchase order is. This can of course be totally electronic. Now, what will Apple do? Apple has got your purchase order. Apple will now raise what is known as an invoice. The invoice is like a bill. It's a bill. Okay, you are having a mobile shop. Fine, I got your purchase order. I got your order for 50 iPhone 13 Pro phones. I see your price is 1,20,000. I am agreeable to supply you the phones, but I need the payment beforehand. I cannot delay the payment. You have to pay me by this day, and I will ship you the mobile phones by courier or by FedEx, and these details will be confirmed in the invoice. So going back, customer to seller purchase order, seller to customer invoice or bill, which confirms these things, the terms and conditions, the bank account, the postal address, everything's there. This is the flow. Now there is a catch. Apple can also say, you have quoted 1,20,000 for 50 phones, which are commercially available at 1,40,000. I'm sorry, I cannot give you at 1,20,000, but I can give you at 1,25,000. So the invoice is raised with that modified amount. And that modified amount is there in the invoice. And this invoice is sent back to the customer. So if required, the terms and conditions of the purchase order can be changed by the vendor or the seller in the invoice. And in the invoice, he can give other terms and conditions also. I'm also giving you another option. You don't have to pay the full amount today. You can pay it little in 3 months. You can pay me the amount. That option can also be given in the invoice. So remember, customer to seller or vendor is purchase order. Seller or vendor to back to customer is invoice or the bill, and the terms and conditions are agreed. Now, what has happened is you have accepted the invoice, you have paid the money to the seller or the vendor, and the iPhone has come back, has been shipped to your place. You have started displaying it in your shop, in your mobile shop. People have started buying the iPhones and you are making money. Now the money has come. Now you raise what is known as an expense receipt, because you have paid the money, right? As a customer, you have paid. Apple has got the money. Apple has sent the iPhones to the person, to the shop, and the shop has started selling. So Apple will now raise what is known as an expense receipt. In that expense receipt, it will clearly say, I received this much money from so and so. 50 mobile phones, iPhone 13 Pro details. It was received, it was shipped to them on that day. The payment was made by NEFT, transaction number, and the mobile phones have been sent to the shop, and the shop has started selling. So that is the expense receipt. I will again repeat. Customer to seller, purchase order. Seller to customer, invoice or bill. After the customer has paid the money, from seller to customer, the expense receipt is sent. This is the anatomy of a transaction, of a financial transaction. Now, here I want to bring the concept of a payable and a receivable. The very interesting thing. Same example. Let us go back to the same example. You made an order for 50 mobile phones. I am having a mobile shop, say Chennai Mobiles or Purvika Mobiles. These are the popular shops in Coimbatore. Purvika Mobiles. I placed an order for 50 Apple iPhone Pro to Apple. Apple has paid me. Now, 50 mobile phones into 1,30,000, you know how much money it is, around 60 to 70 lakhs. I don't have the money with me. I want 50 Apple iPhone 13 Pro, but I do not have the full money with me. So what I do, I will tell Apple, see, I want 50 Apple iPhone Pro. There is huge demand here in Coimbatore at my shop, Purvika Mobiles, for the Apple phone. I'm sure I can sell within a week. I will sell the 50 phone, but I don't have the cash to give you now. So please accept a special request. For the 50 iPhones, I will pay you a flat amount of 25 lakhs as a down payment. The remaining 40 lakhs, I will pay you in 3 months. In 3 months, installments of say 12 lakhs. So what has happened is here is there is a payable and a receivable. As the mobile shop owner, Purvika Mobiles, I have made an order of 50 mobile phones, Apple iPhone Pro. I don't have 60 lakhs to pay him for the full amount. So I pay a 25 lakhs. Remaining 35 lakhs, it is a payable for me. And for Apple, it is a receivable over the next 3 months. Is this clear? So this is the concept of payable and receivable. And mind you, most of the time, all businesses have a lot of payable and receivable. I mean, people need money, right? Sometimes you don't have the money, right? Some movie is there, no, Jerry Maguire, show me the money. That money is not available, right? So you need to make a terms and condition. So you are saying, okay, as Purvika Mobiles, I'm paying you 25 lakhs, remaining 35 lakhs, I'll pay you in 3 months, right? And for me, it is a payable, Purvika Mobile, and for Apple, it is a receivable. So this gets into the financial statements. I hope you have understood. Now coming to what is revenue and expense. I already told you, any money that comes inside, you get the money. That is a revenue. Any money that goes outside, you are giving outside, you are paying, that becomes a expense. So obviously, a payable and a receivable are also revenue and expense, but they are deferred. They only come in the future, right? If it is payable for me, I have to pay in the future. If it is receivable for Apple, Apple has to get it in the future. But ultimately, it is either a revenue or an expense. A revenue is money that is coming inside. An expense is money that is going outside. Now, for all revenue and expenses, we need to keep track. I told you, if you see this accounting thing, every single day you have to keep track. Every single day, every single business transaction, whether it is a purchase, whether it is a salary, whether it is the tax, whether it is anything and everything you need to pay. You keep track of that. From that, you get to what? You get to the revenue and expenses. Revenue is money that is coming inside, inflow. Expense is money that is going outside, outflow. And when you keep track of this, when you look at the revenue and the expenses, you collect them, say, for 1 month or for 1 year or for 5 years, you get what is known as various financial statements. Multiple financial statements. The first statement that we see is a cash flow statement. Cash is extremely important. The cash flow statement answers the question, do I have money to, do I have cash for running my business? A cash flow is not actually taken monthly, it is taken daily. Whatever money today is coming inside, whatever money is going outside. Money flowing in, revenue, money flowing out, expense. But each and every transaction, each and every revenue, money flowing in, each and every expense, money flowing out, is captured in a cash flow statement. And cash flow statement, you can take it daily, you can take it fortnightly, once in 2 weeks, you can take it once in a quarter, once in 3 months, you can take it once in 6 months, you can take once in a year also. This cash flow statement is the sum of revenue to the sum of expenses. Now, I don't need to tell you. If your expenses are more than your revenue, you are having a loss. If your revenue is greater than your expense, you are running a profit. This is very simple logic, right? So a cash flow, cash is extremely important. We say cash is like the blood in the human body. The human body ceases to live if there is no blood, because the blood makes a very important function. You know about that in school. You have learned about it. The carbon dioxide and the oxygen, that balance is maintained by blood, right? Similarly, cash is the blood of an organization. If there is no cash, that company does not exist. Only if there is cash available. The cash can be in your hand, the cash can be in the bank, the cash can be anywhere. But if you do not have cash, you cannot run a business. It is as simple as that. So, cash flow statement, you can take it daily, you can take it monthly, you can take it 6 monthly, you can take it 3 monthly, quarterly, you can take it once in a year. And that will show you how much revenue you are getting inside. That is the money flowing in and the money flowing out. Now, when you this is how a cash flow statement looks like. This is like it's taken for a month, if I am not mistaken. How much cash you have received and how much you have paid for. When you have received money from clients or customers, you got this much money. And see, this is very clear. Your revenue is, what is this, 1,048,000 rupees. Your expenditure is 5.52 lakhs, and you are having a cash flow of 4.95, which will become your profit at the end of the year. Now, the income statement is nothing but the cash flow statement for 1 year. I will repeat. The income statement is nothing but the cash flow for one complete year. Normally, all enterprises take it from April to March. It is also known as a financial year, meaning April 1st, 2022 to March 31st, 2023. That will be a financial year. And in that financial year, what is the cash flow for the entire year in terms of what is the revenue for the whole year, what is the expense for the whole year. And I don't need to tell you that revenue minus expense is equal to profit. If expense minus revenue is equal to loss. It's a very simple logic. And in this example, you get the revenue is 27,800 and the expense is 14,000, and you have a profit of 12,950. And sometimes this income statement is also known as a P&L account. P&L also stands for profit and loss account. This is another way to call the income statement. I will repeat. Income statement is cash flow for one full year. Total yearly revenue minus total yearly expense. 1 year's cash flow is the income statement. And this income statement, when the revenue is more than the expense, you have a profit. When the revenue is less than the expense, you have a loss. It's very simple. Now, coming to the last financial statement, it is the balance sheet. The balance sheet is a historical document. Historical document means, I will explain. Suppose you have, you are starting a shop. Let us say mobile shop. You need a building. You need to construct a building. You need to have land. You need to buy some, have some furniture fittings. You need to make a fan. You need to put air conditioning. You need to do so many things to set up the shop, right? That's a law. That is your building what is known as assets. So when you are starting the business, you have to spend money to build the business. You have to develop assets. You have to have some land, you have to construct a building, you have to put the electricity connection, you have to put the fan, the air conditioning, you have to have nice showcase to show your mobile phones. You need an electric connection, you need an internet connection. All this will make you spend a lot of money in the initial stage of the business. And that will translate into what is known as the asset. So asset will not come every year. Asset, you may start the shop today. Then after every year, that asset amount will not come in the profit and loss or the income statement. Income statement will only show that year's income, that year's revenue, that year's expense, the cash flow for that 1 year. So if you had started your company 3 years back or shop 3 years back, that will not be reflected in the income statement or the profit and loss account. I told you P&L or profit and loss account is the same as income statement. Now, in the balance sheet, all these things will be reflected. Your assets and liabilities. Now, I told you 3 years back, you set up the shop. You bought some land. You constructed a building for the shop, mobile shop. You bought furniture. You bought fancy lights. You bought showcases. Then you bought some initial inventory of mobile phones. You have to buy, only then you can set up your shop. All this you incur a lot of expense. You don't have full money with you. You took a loan from the bank. That happened 3 years back. Please understand. So all those things will be reflected in what is known as a balance sheet. The balance sheet is listing the asset and the liability. The asset means land and equipment. If you are having a factory, all that equipment in the factory is your asset. You are having a computer institute. Computers in your computer institute will be there. If you are having a hospital, the beds in the hospital, the operation theater, the X-ray machine, all that will get into the land and capital equipment. But there is a catch. Every single year, there will be a depreciation. A depreciation means a value of that thing goes on reducing. I'll give you an example. If you have an iPhone 6 or an iPhone 8, who is going to buy an iPhone 8? Today, iPhone 13 has come, iPhone 13 Pro has come. Or you have an iPhone 5. Nobody will buy that phone. The value of that iPhone 5 is 0. Even if you give it to somebody, they'll not know. I mean, I'm not talking of some beggar or something. You give it to some sane person that, you want this iPhone 5, my old phone. Nobody will say, I don't want that. Because the value is almost 0. The value comes down. Likewise, any land and capital equipment that you buy in the first, when you started the business, the value comes down. Then other things are intellectual property, cash, accounts receivable. I already told you, you are supposed to get money from somebody else. Inventory, you have phones stock in your shop. And retained earnings from previous years. So last year I made a profit of 12,950. That profit will be added to the balance sheet. Retained earnings from the previous years. Now let us see the liabilities. Liabilities are loans that you have taken. You may be taking loans, short-term loans. You may be taking bonds. Bond is a long-term loan. After 10 years, you take some loan from somebody, give him a bond and say, after 10 years, I will double your money and give, but that money I won't give you for 10 years. After 10 years, I will give you double. Short-term debt loans, long-term loans, accounts payable, what you have to give others, interest payable, taxes payable. And the minus, the asset minus liability is your equity. Equity is the measure of the share capital or how much you have your share capital in the company. So the balance sheet is an annual statement. Balance sheet takes the historical perspective. How much money you have invested in the beginning? What are your assets? What are your liabilities? Asset means the land, building and everything, equipment, but they are all every year slightly it is going down, depreciating. And the liability, how much loan you have taken, how much you have repaid and all those things will come under the liabilities. And the asset minus the liability is your equity or share capital. So that also reflects in the balance sheet. So if you have, suppose the company is 100% owned by you, entire equity is in your name, the share is in your name. But next year you decided I have brought in 3-4 partners. You give some equity to that partner. All that will be reflected in the balance sheet. So these are the the major statements that will be there. So asset minus liability, you will get the equity. But finally, the asset and liability and equity will balance. Asset is on the left side, the liability and equity will all be on the right side. It should balance at the end of the day. That is why it is called a balance sheet. It has to balance the asset on one side and your liabilities plus equity on the other side has to balance. So these are the simple, financial statements, and these are not rocket science. Anybody can do this. Is very simple, right? Making a simple balance sheet, making a simple income statement, cash flow, anybody can do. It's very, very simple. There's no rocket science, no high funda stuff is there involved at all. Finally, I just wanted to give you tips because you are now becoming entrepreneurs. You're becoming entrepreneurs. You're being a tinkerpreneur. You're running a company. You're building your own digital business. Certain things, small tips that I want to tell you. Always have a separate bank account for your company. Don't mix it with your personal finance. It will come confused. Never ever mix with your personal account. That will only confuse you. Then I have told you the other things, purchase orders, all these things can be done electronically. One more very important thing is each and every transaction that you do, whether it is physical, giving cash, giving a check, doing an NEFT, doing a Google Pay, every single thing keep track. So these are 2-3 simple tips that I want to say in addition to never mix your personal and professional. Your bank account for your company and your personal account should never be mixed. It will only create confusions. So with this, I'm very happy for this opportunity. I hope you got some input from what I have tried to convey to you. I'll be happy to answer any questions. I'll stop the sharing and yeah, I'm now open for questions. I see. Yeah. How Tanvi ji has given a question. How much percentage in advance should we at least pay on taking a loan? See, it depends actually. See, when you are taking a loan, there is some logic with your which is related to your sales and your asset. There is some logic on that. Now, I'll just give you an example. See, you have, say, assets worth 1 crore. Okay. You only have assets worth 1 crore and you are taking a loan of 10 crores. Suppose your business fails. What is going to happen? I hope you understand what I'm trying to say, right? You only have 1 crore asset and you are taking a loan of 10 crore. Assuming your business is successful, nothing to worry, you will make money. But suppose you don't be successful, you have lost everything. That 10 crores, where will you pay? And normally, all these loans come with a catch. They come with what is known as a collateral. Collateral could be the land, could be the building, could be some investment of it could be your house also. You might have to put your house as a collateral, right? You will not have a house at the end of the day. So you should always plan accordingly. So when you are taking a loan, see the percentage, see your asset, see how much of sales that you have, what kind of sales that you are expecting. Say in the next 5 years or next 2 years, I'm expecting this much of revenue. You should make a projection of all this. And based on that only you should take it. There is no correct percentage and all. There is no percentage. There are people who take huge loans and, they just vanish. But there is no rule also. People just give loans based on some collateral there and all, so on and so forth. But you should, when you are taking a loan, think of the percentage. Okay, this is my asset. This is how much money I have. And this is going to be my sales and revenue for the next 2 years, 3 years. And based on that, you should take a decision. Another question from Meenakshi Sharma. I have made an app, but I don't know how to share it with others. See, ultimately, an app is something, there are 2 things to this. When you are making an app, you should make 2 versions of the app. One is for Android. There are people who are crazy for Android. There are people who are crazy for Apple. I am from the second side. I've been using an iPhone for the last 10 or 15 years. I've been using one iPhone after the other. I'm even though I know Android has good things. So if you are making an app, you should ensure number one, it should be available on the Google Play Store in Android versions of phones like Samsung, Nokia, and so on and so forth. It should also be Apple iOS compliant. Means you should can go to the Apple store and you should be able to download it. Number one. Now, how do you share it with the others? When it is there with you, you have to use some sort of digital marketing tools. You can put Facebook ads because an app is electronic. That means the person is using a smartphone. So the person is electronically connected anyways. Now you have to use some kind of digital marketing tools. You can make good websites, or you can promote through social media like Facebook. You go to Facebook or LinkedIn, do some sort of digital marketing and say, oh, awesome app, 10,000 app downloads in 10 minutes. And then that's how you should market and try to get your app outside. Just putting an app on Google Play Store or putting an app on Apple is not going to help you, because there are thousands and thousands of apps available. So you need to do some digital marketing. That's how you should. And of course, word of mouth. That is also a very popular thing. What I told you is the formal advertising. That is social media ads, Facebook, LinkedIn ads, and all. But informally, spread the word. That's how things are move on to the community. And many of these technologies, especially computer related ICT technologies, spread viral. What is that, TikTok and all, in some apps and all, in a matter of hours, you get 1 million downloads and all, because it's word of mouth. It's like a movie. India earlier in Hollywood, every movie works on is released on Friday. And on Friday, Saturday, Sunday, the opening weekend on Monday, you know whether the movie is gone or not. It was not like that in India till recently. Now India also it is like that. The first 3 days the movie runs, hit ho gaya, nahi to flop ho gaya, nahi to blockbuster, all that will happen. So that's how you should market.
Thank you so much. Thank you so much, Dr. Prashant. And those were the questions that we had received. And I would like to say that thank you for simplifying the concepts. And I'm sure that the students who had joined us, they have learned a lot through the session. And I must say that those tips in the end of the session were really helpful. And I'm sure that these young entrepreneurs are going to, pick up from those tips and really implement it while they are running their enterprises. So, thank you so much, and thank you all the viewers who had joined us today. We request you to stay tuned for some more exciting sessions on Tinkerpreneur. Good evening.
Good evening. Thank you, Tanviji. Thank you. All the best.